Ambuj Chandna, the President of Consumer Assets at Kotak Mahindra Bank, also joining us now to discuss, of course, the rationale behind the home loan rate cut and the ongoing competition in the market currently. Ambuj, thanks for being with us. Explain to us the rationale behind the cut when rates are already trending at a lower level currently. Why did you feel the need for a cut in the quantum as well?
Well, Aisha, I think the first thing to ask is what's happening in the housing market, because housing finance is to some extent dependent on that. And what we see is a big jump in housing sales, and reasons we all know. There is a big work from home factor. The fact that the schools and the offices have now shifted to our homes, leading to demand for bigger houses. There's also a correction in the core property market, right? We see top developers who have a lot of ready inventory, ready to move in inventory, correcting their prices. And sure, the governments are helping in terms of stamp duty concessions in certain states like Maharashtra. But one big factor for this whole housing boom, in my mind, is the fact that the rates are at a 15-year low. That is helping making buying a new home affordable for consumers. So I think that's the core reason. I think the current market rates are leading to expansion of the housing market per se, and allowing consumers to buy houses. And that's how banks are going for it. And banks like us are pricing ourselves rightly for the consumers.
Sure. Thanks for painting that context, Ambuj. Tell me, with the cut in rates, particularly as the competitive intensity in the space intensifies, are you seeing an expansion of market share as well, vis-a-vis some of the leaders, the pre-existing leaders in the space?
Of course. Housing for Kotak is a focus segment. It's a portfolio we want to grow and we want to work hard on, which is why our current positioning, we are today at 6.65%, priced the lowest in the industry, and our focus is to grow this segment for us. So market shares is important for us. And, very important, there's a reason for looking at market share. The reason essentially is that the bank where consumers tend to have their home loan is the space where they do bulk of their banking. They tend to have their core bank account there. They tend to kind of do investments through that. And hence, we want to kind of put ourselves in the space to be able to grow the whole, customer franchise that we have.
Okay. The rates which currently most of the banks and HFCs are offering, do you think that is more like a bait where there is a market share gain rather than a profitability ambition? Once the customer is associated with a bank, of course, you can offer him more services, and that's where the fee-based income will increase. Do you think such low attractive rates are in a sense more like a Flipkart sale? You draw a person to a website and that person ends up consuming and buying more?
No, I don't think so. I think the current rates are profitable, and on marginal basis, it's a viable business for banks on standalone home loan basis. The fact is that there's adequate supply of money in the market. Banks have enough liquidity at this moment to be able to do that. And look at a bank like us. We today operate at one of the lowest cost of funds in the industry. So I think banks in general, and we have an ability to price this to make it relevant and valuable for us, and attractive for consumers.
I'm going to ask you a question, perhaps not for a very sophisticated investor, but for the general audience, and we'll try and put this on digital also. For someone who's planning to take a home loan, what to your mind is a better option? Go for a floating rate or lock the fixed rate right now because interest rates are low?
Well, given the tenor of the loan, the rate which is available in the market today is the floating rate. I don't think many banks and institutions do offer fixed rate. So I don't think that option really exists in home loans. But if it were to exist, it will come at a premium. It won't come at the current rate of 6.65%. So I would tell consumers to go with the current rate at 6.65%. I think the current architecture, with all these rates being linked to repo, is a very fair, honest, and transparent architecture. So I don't think consumers need to worry too much. I think the play, specifically the banks, which benchmark to repo, it is a very, very transparent process. So I would suggest go with floating and make use of the current rates that are available.
Okay, thank you for that answer. When interest rates are increased in the system, I've normally seen that there is a lag effect, which is that interest rates at the consumer end, they go up automatically. On the deposit end, they go with a lag. Do you think the same phenomenon could be at play this time?
So there is a lag to the extent, so look at the current construct. The home loan that a consumer takes is linked to repo, and the transmission happens within 3 months after the repo changes, right? So there is that lag of 2-3 months for transmission to happen when they go up, but that's about it today.
Okay, fair point. How would you really define the dynamics of not the entry-level buyer, but let's say a demand on the demand front? Let me qualify my question. On the demand front for home loans between 1 to 5 crore, because while we can talk about the HFCs, we can talk about home loans under 1.5 crore, 2 crores. On the higher ticket, what is the trend which you are picking up?
You mean to say on the demand side? That's your question, Nikunj?
Yes, please. I'm just trying to because you're in a perfect place, sir, to tell us that what is actually happening to the demand front, because we get two set of data thrown at us. What is happening to the low end, which is HFC, and what is happening to the high end?
First thing, what I'd like to tell you is that as of today, the market is a bit concentrated between top 4-5 banks and a couple of HFCs. Right? The large distributed market today doesn't exist because of the liquidity situation. But coming back to your question, I think in terms of demand trends that we see, Nikunj, is we see a slight skew in demand in sub 1 crore segment. We see, and that's also a segment we cater to very, very aggressively as banks, right? So we see a lift in demands in that segment. Above 1 crore is also there, but and it's also much stronger than it was in the past, but but pre 1 crore is doing marginally better. The other broad trend, and I think it's important for your viewers to know that the core housing sales per se, today, if you look at Q3 of this financial year, was up 80% over Q2. So there is a very broad-based lift happening in both metros and non-metros. So I like to say, while we can kind of pick up numbers and say this segment is slightly more than the other, but it's a very, very broad-based demand trend that we see.
So, Ambuj, what is your sense? I mean, can rates go further lower than this? I mean, is it even a possibility for them to shrink lower than what they're currently at?
Well, at a 15-year low in the housing loan market, I think that's an unfair question to ask, Aisha. I think the rates to some extent are at a 15-year low, and we need to acknowledge that. While we'll see how it goes from here, but for example, for us, when we offer 6.65 today, we have clearly announced that these rates are valid till 31st of March. We know that March sees a bit of seasonality, and it's a big month for the industry in general. And we want consumers to benefit from these rates in the peak month. And we'll see it after that. But right now, I would say that we are pretty much, the rates are extremely attractive at where they are today.
Okay. So you're saying that if you're contemplating buying a house and taking up a home loan, till the month end is your only window?
I'm not saying it's the only window. I think till the month end is a very bright window. And, it's not just about buying homes. In this market, we see a lot of trends toward balance transfers, right? Let's remember, housing finance is a category where there are no foreclosure charges. So cost to shift for a consumer doesn't exist. So if you are sitting at a rate which is higher, I think as a consumer, this is the time to take advantage of the lower rates and shift to a lower rate, either with your existing bank or to a new bank which is offering those rates. So I think we are pretty much at the bottom, while we'll see where it goes from here, but the rates are very, very attractive today.
That's a very academic question here, Ambuj, but part of the market is discussing this, so I really want you to spell it out. Is the home loan rate cut more to do with lesser secured, profitable avenues to lend for banks? Because part of the market does believe this. I mean, are banks shying away from lending to relatively riskier assets? And that's why this push for home loans and almost a home loan rate war playing out there, if I can call it that.
Look, I think what's important to know that on marginal basis, home loans is a product which makes sense. I explained the logic around the fact that it gets us the larger wallet of customer revenues, but also, the risk cost in home loans is by far the lowest. We all have seen over the years that the last loan you default on is a loan of your house, right? You can, as a consumer, you hold that in the current state till your last breath. That's what consumers typically do. So ability to price this low also comes from the fact that risk costs are relatively lower, ticket sizes are higher. So in effect, the cost of acquisition is relatively in control. So the whole revenue dynamics of home loans in itself makes sense. I think the focus is because it's a segment which is growing and we can see it. So when it makes sense on a marginal basis and you can see growth in the segment, then it's completely intuitive to participate in it.
Okay. Closing comments really. Now, if I look at the home loan market, the 4-5 large banks, the 2-3 large NBFCs, all of them are in a sense inclined to build a portfolio which is tilted towards the service class. India is a service-dominated sector, complete logic in it. And the smaller NBFCs historically have given it to the non-service class. But there's a problem with smaller NBFCs. Are you inclined now to give loans to the non-salaried class? If yes, what are the trends there?
What you're saying is completely, I think as Kotak, we've always specialized in self-employed as a segment. That's a segment we've always done extremely well in. And still a very large percentage of our loans comes from the self-employed segment. I think what's important here is that the self-employed segment per se is slightly tricky in Indian context from a credit evaluation perspective. And, various entities have worked at different space in terms of building credit models around it. I think we've been good at it for a very, very long time. And I think we have very strong, robust credit models to work in this space. And we are very strong. So I don't think, at least in our context, we want to grow in both the segments as much as the opportunity, but we are very, very comfortable with self-employed. But yes, I do know of certain banks whose credit models are more developed in the salaried space, and they may kind of focus a bit on there, but definitely not true for Kotak.
All right. Ambuj, thanks so much for joining us this morning.
Thank you. Thanks, Aisha. Thanks, Nikunj.